You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old network where we break down the sometimes impenetrable and scary world of options for you, the busy financial advisor and asset manager who's looking maybe to dip your toes into those waters. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. Quite a few programs for you guys to check out, pretty much a dozen. Easiest place to get all of our great content, including all the back episodes of The Advisor's Option. You can go to our website, theoptionsinsider.com, or to your favorite audio provider, iTunes, TuneIn, Stitcher, and so on and so forth. You can always grab our mobile app and enjoy it there as well, or grab our Mixlr feed where we're doing a lot of live stuff over there these days as well. So no shortage of ways for you guys to find and enjoy all of our great programs. And of course, however you listen, live after the fact, make sure you hit us up. Questions, comments, insights. We have a ton that come into this show. We try to answer as many as we can. We'll see if we can get some onto the program today. Looking forward to doing just that, and joining me to help me do that, of course, are my cohorts, my partners in crime. Starting off, let's go all the way. Let's go from north to far southeast and then back close to Chicago. So we'll start off all the way in the still frozen Northeast. I believe they're just coming out of the tail end of their fourth nor'easter in as many weeks, or whatever they call them these days, bomb cyclones. He is Matt Ambertson, the founder over there at Options Research and Technology Services, a.k.a. ORATS. Matt, welcome back to the show. Have you dug out from your fourth storm up there in New Hampshire yet?
Yeah, it's white outside, but this is going to be a hot show, Mark. I'm excited. John Cherry from Northern Trust, very excited to meet him down at RMC. And, of course, the television personality from NASDAQ. We saw Chris Hausman on the TV, so that was great to see Chris. And I'm pumped for the show. Mark, let's get it going.
It's going to be a fun one. You're right. Chris, let's welcome on. You already did my job for me, introducing all of my co-hosts here. We also have Chris, the budding video star over here. They actually got him out of Puerto Rico. I don't know how that happened. They got him all the way to New York, to the NASDAQ market site, where he did some hits with our old friend Jill Malandrino, who's been on this very network many times over there. So it's fun to see him. Of course, Chris Hausman, the portfolio, let's just call him the overlay man about town over there at Swan Global Investments. Chris, welcome back to the show. Congrats on your budding video career here.
Hey, Mark, thanks. It's good to be on. And I guess I'm going to start signing autographs.
Yeah, you got headshots. I know I got one in the mail signed. It was very nice. We have it up here in the studio, so you should send one over there to Matt. Sounds like he's perhaps your biggest fan. And last up, Matt already mentioned him. We have a guest filling in here on the old special guest co-host chair today. He's a newcomer to the program, even though if you listen to our interview show, he's been on the network recently for the first time. He is John Cherry, a vice president over there at Northern Trust. John, welcome to the Advisor's Option.
Thank you, Mark, and appreciate the introductions from everybody. It's happy to be here today.
And John, we did a little catch-up down at RMC a few weeks ago. Our listeners can find that on our network if they want kind of more of a deep dive into what you guys are doing over there. But maybe really quickly for our listeners of this program who maybe missed that one or are new to this episode, give us a really quick overview of, Northern Trust. What are you guys doing over there in the option space? What brings you on to the Advisor's Option show today?
So I sit within our capital markets offering, Northern Trust Capital Markets, where we service the needs of our clients, both in FX, securities lending, and in brokerage. I run our U.S. options business, servicing two main segments, our asset owner segment and our asset manager segments. Asset owners consisting of public funds, family offices, and foundations and endowments. And on the asset manager side of that, servicing both hedge funds, 40X, and RIA, specifically as allocators. And so certainly see that as a way to, sitting in between those two segments, I find there's a nice interconnected relationship where we're both able to service the needs of asset owners and asset managers.
Well, we're always happy to have more firms joining the party here to talk options. So without further ado, let's do just that and dive right on into our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
Everybody, welcome to our Tricks of the Trade segment, the portion of the show where we kind of break down how we view and use and see tools in the market and kind of break down some of the interesting developments that are going on in the marketplace right now. We did this last show. We thought we might be done for a little bit talking about the return of volatility to the space after the big February 5th, February 6th meltdown, call it what you will, and then the resulting resurgence of the S&P. And yet here we are a month and change later on our next episode. Pretty much got a similar discussion, only this time we're coming off the heels of a big sell-off last week, then a explosion to the upside, I think you can call it, just on yesterday's session. Most of the major indices up close to 3% or in that neighborhood there, so just an explosion. Volcanic eruption to the upside, call it what you will. So a little bit of a tale of two different markets a month or so between, with just aggressive moves to the downside and then, of course, explosive moves to the upside. So we've seen a lot of things exhibited in the space from a volatility and a general movement capacity over the past month and change. So certainly an interesting and perhaps a challenging one for a lot of advisors out there who are managing their clients' assets and trying to explain to them what's going on with this volatility, and also trying to manage their capital in these markets. So it's always a good time to kind of check in and see how those things are going. I kind of get a little bit of takeaways of what's going on out there in the space as well. And John, since you're our guest, I'll give you pride of place. You also weren't with us on the last episode, so if you want to extend your thoughts back to include February 5th and 6th and all that tumult, you can as well. But obviously, we're coming off the heels of some very aggressive moves in the market just in the last few sessions. Last Friday, we saw an enormous sell-off. Of course, a lot of it driven by concerns over the trade wars and some meltdowns in the technology space and a confluence of other events really giving a 1-2 punch to the market. Then, of course, we come in this week. We saw pretty much the exact opposite. We saw the market erupting to the upside. Today, kind of settling out a little bit. So we're seeing some very turbulent waters out there. What's it like for you? What are you guys doing over there at Northern Trust to manage this volatility? And also, what are you hearing from your clients in this last month or so of very, very turbulent markets?
Well, I think you kind of hit the nail on the head. I mean, that's really just it. As far as having conversations with clients around what we're seeing and what we're hearing within the marketplace, it makes for very good conversation. I mean, there's no question in my mind that we are in a new market, a market that is pricing in a little bit more uncertainty, which is making for these whippy movements within the marketplace. That being said, we've been in such an environment of low volatility for so long that, people looking in the rearview mirror really can't see that far back. And so what we're experiencing, in my opinion, within the vol markets is an elevated volatility, but not something that we haven't seen before.
So you're right. This is not something that is new to certainly anybody here on this panel. So you're not seeing a certain amount of, shall we say, panic from your clients or anything along those lines, and also you're not doing anything markedly different to really adjust your strategies in light of the dramatic resurgence of volatility in February, and now we're seeing the continued volatility going into March here.
No, that's right. We see it more as opportunity on some of our clients that have, self-directed type portfolios, whether that's in the hedge fund space or in the private wealth space. These are really good opportunities to look to take advantage of using option-based solutions within the portfolios to look to capitalize and or hedge some exposure. So I actually welcome kind of these type of events where you're able to get on the phones and talk to your clients about things they might want to be looking to change within the portfolios.
And maybe you kind of touched on it there a little bit. Maybe we should set it up a little bit for our audience as well, since this is your first time on the program. What would you say is the predominant options use case for a lot of your clients? Are most of them coming to you looking for hedging? Are they looking for income, or maybe a combo of the two? And also, has that changed in the last month or so? Have they started calling up maybe more looking for hedging or something along those lines, or is it still pretty much as it has been over the last year?
Well, majority of the institutional clients we service are long-term investors, right? So let's take a look at the asset owner space for a moment. And you're looking at family offices or foundations and endowments. These are very large institutions that don't necessarily make big movements based on short-term swings within the marketplace. However, like I mentioned earlier, that creates opportunity for me and my team to call them up and say, are we comfortable with our exposures that we have on? And if we are not, what might we be thinking about as far as use case for an option scenario, which could be considered? Most often we've seen kind of broken out into three buckets, covered, using the use of covered calls on long positions that they don't necessarily want to get out of, but would be comfortable getting out of at a certain price or time. Another bucket would be certainly the protection and hedge strategies that we have based either around an individual security or an index or ETF. And then kind of that third bucket would be what I would call kind of everything else, long volatility players, short volatility players that are looking to kind of somewhat get cute based on an individual theme or objective.
I like that. The getting cute bucket. Is that what you call it over there? You're in the cute bucket. I like that. So the clients who want to get cute, they can get a little funky, get a little bit more esoteric, get into the weeds a little bit. We like that. Chris, you're out there, managing your portfolio day to day over there for the DRS over there at Swan. We kind of touched on it last episode. Your thoughts on that market volatility. We kind of thought maybe we had seen the extent of it, but coming into March, we're seeing a resurgence of it again. In both directions. People always have this somewhat one directional view of volatility, that it's only to the downside, but the market rallied nearly 3% yesterday. That's volatility, however you want to define it. So these are interesting and perhaps challenging times from a variety of different perspectives. What's it been like for you over the last month, Chris? And what are some of your thoughts as we're seeing, the market just take these tremendous moves to the upside and the downside within a session or two of itself?
Yeah, I mean, the marketplace is trading a little bit in between first quarter of 2016 and the second half of 2011. So, we had a 12% down move first week of February. We rallied 10%. And now we're in the middle of a 7% down move, from local highs to local lows. So this is actually a good time to let options shine. So people are understanding that hedging does work. They are understanding that higher volatility environment or regime, which is the catchword all of a sudden, can implement added income, kind of, like what John was alluding to. So it's been a good environment. I think the environment is tradable now. We haven't had a tradable environment for such a long time. And markets are reacting to news. Markets are trading technically, meaning, support, resistance, moving average, all these things that we all read about in books that couldn't use over the last year and a half because the market just went one way, or there was just really one strategy, right? Buy the dip and sell the rip as far as volatility is concerned. So I like what I'm seeing. I think there's a lot of opportunities out there. For people that can use all these tools in conjunction and can add, value to individuals' portfolios by understanding, what's the best place to use these options. Is it an hedging aspect, or is it income/yield enhancement? So, one of the themes in the last part of 2017 was stock replacement. So all those people that kind of sold off, their actual underlying and went into strategies that replaced or replaced those deltas or underlying movements, have done a pretty good job thus far by taking off a lot of risk off the table.
And obviously you have kind of two goals over there when you're managing the overlays over there at Swan. You have the long-term hedges, of course. Then you have the narrow term, which is the income component. And that's obviously where you spend a lot of your days, particularly in these types of markets. So walk our listeners through the advisors out there who are maybe looking to implement some income component for their clients out there. Walk them through what that's been like for you over the last month, and maybe any interesting takeaways you might have as you're looking to put on, the covered call and, of course, the short put kicker, I suppose you can call it, over there on the income side over the last month or even over the last week.
Well, the higher income the higher volatility regime has been good for us. I mean, I think, like I said, things are trading a little technically. So resistance is now meaning something. Support is now meaning something. So you can lean on those levels when you want to implement covered call strategies or cash secured puts on the downside, et cetera. So we kind of employ a combination of both where we are looking to sell upside calls. We are also looking to sell downside puts to add incremental value to a portfolio. So it's about timing. It's about we're able to use additional tools now in this market environment, or some tools that just haven't really worked, during 2017 when the volatility environment was so low. So I like to see this, where the VIX is right now, 15 to 20. That's a really good juicy spot. It's kind of like where the porridge is just right between, realized volatility and implied volatility. And, Matt and I have talked about this a lot of times on the show, is like I'm kind of afraid of very high vol because there's a reason for that, where the underlying or realized volatility is moving and it justifies a high implied volatility. Those times can actually be more challenging to harvest or capture this risk premium. Now, the other side of the coin is when volatility is at an absolute low level, because you're thinking in the back of your mind, it's a good harvesting risk premia environment because realize is so low, and there's a healthy risk premia there. However, in the back of your mind, you're waiting for this first week of February to happen, right? Nobody in 2017 mentioned volatility regime change. And now all of a sudden, you hear it every single day. So it was a painful shift. It was a quick shift. But again, we've seen this before and we're prepared for it. And I think, like I said, moving forward, there's going to be a lot more trading opportunities.
Yeah, you're right. It was a pretty sharp and aggressive regime change. It is surprising, given how many times we talked about it on this show and throughout our entire network for 2017, how this eventually the low vol regime was going to come to an end. I mean, maybe not this abruptly or this dramatically, but everyone knew that was eventually going to happen. And yet it is amazing how many large options funds out there got caught with not with the proper risk management, shall we say. And there are fewer these days now in March than there were in February as a result, which is kind of interesting. Maybe you think they should listen to a show like this. They could learn their proper risk management, and then that wouldn't be the case. Matt, you're interacting out there with a lot of different clients and a lot of different segments of the space, advisors, asset managers, trading firms, all sorts of people out there. What has kind of been, what are you hearing from them? What has been the takeaway from them over, of course, the last week, because it's been very topsy-turvy over the last week? Are they looking for anything kind of specific or unique from a back testing perspective? As John would say, are they getting cute out there? Or are they kind of towing the line with the more traditional conservative stuff out there these days?
Yeah, we've had more people come in over the last weeks than we have ever, and so it's great. I think people are starting to figure out that options used wisely can help them meet their investment objectives. To riff off of what Chris said, in the environment now, much like what we've learned, the rules of thumb from back testing are that when the market doesn't get the volatility high enough in the bad times, in the very volatile times, and they don't get it low enough in the less turbulent times. So even before, what that means really is that even before the February, the realized volatility was low single digits, and vol was still at a respectable type of a level, but there was still that big difference between implied being far over the realized. But recently, even I'm looking at my numbers, and the actual volatility, especially in the last couple of days and then in February, has been well above where the market is pricing it. And so I actually think that I do agree that there are some opportunities, but what I'm seeing is that there's actually it's fairly, if not a little bit cheap even now, if you look at what's happening to realize. And these last few days, down 2.5%, down 2.2%, up 2.7%, with a lot of intraday volatility. That's realized volatility that's going against these the implied volatilities. One of the takeaways that I had down at RMC was that I hadn't heard before, but these larger insurance firms are getting out of positions if the historical volatility or realized volatility gets to a certain level. And I think that has exacerbated some of these moves, because they got to get back in and then they get back out, and they're missing some moves. So I don't know, I'd be curious to hear if you've heard of that. I think it did have, there were quite a few different things that led to more volatility when volatility starts, i.e. the short vol trade. But now, if people are looking at realized volatility, the market starts to go down and there's more selling, that it seems like there's, after quiet times, these volatility moves are much more severe than, I can recall, Mark.
Yeah, definitely it is more pronounced. Heck, we have a lawsuit against the SIBO, and I think Credit Suisse or a few others out there that are pretty much, those are multiple lawsuits, I believe, that are all alleging all sorts of things are going on in the volatility space. I think the answer, quite frankly, is no one really has a complete handle on what is driving all of these aggressive moves in the volatility space. I think most people probably back away from the extreme, shall we say, conspiracy angle of some of the lawsuits and recent developments out there. But you're right; they are very stark, very somewhat concerning moves to some people out there who maybe aren't used to this, who don't have a long frame of reference in the option space. And you're right; it wouldn't surprise me if a lot of these funds are starting to do that unwinding as a result result, we certainly saw a lot of firms that I thought should know better in the space over the last month and a half shut down as a result, because they clearly did not. So at this point, this aggressive amount of volatility in the space, really nothing would surprise me. And that's a great setup for the things that are going on right now, which is a great time to roll on into our next segment that we call The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz, a portion of the show where we break down the big news, the hottest trends, the big developments and breaking stories out here in the world of options that pertain to you, the busy advisor or asset manager out there. Going to kick things off. It's been a while since we've all had a chance to gather together on the show. We've all been traveling. Chris has been doing his video tour. Matt and I were down at RMC. Then I was at FIA. So we've been doing a lot of things since our last show, but we finally have time here right before the end of the month to get back together. So, of course, we need to look at how all this crazy volatility has been impacting the overall world of options. And spoiler alert, from a pure volume perspective, it's been a good thing. We have the numbers in for February. We're getting close to having the numbers for March. A few more days, we'll have the total numbers for March. Obviously, those aren't available yet. But looking back at February, of course, we had those big days, February 5th and 6th, where it just seemed like the world was coming to an end. Volatility was exploding. That sort of thing tends to drive some options volume. That's exactly what we saw, last month with the OCC, our friends over there, the OCC reporting total cleared volume for them up 43% in February from February of 2016. So year over year, 43% increase. Of course, they clear a lot of stuff over there at OCC, so we parse it down a little bit more. Exchange listed options volume hitting about 465 million contracts in February. That's up 44% from February of the previous year. Equity options volume drilling down a little bit farther, hitting about 398 million contracts. That's a 40% increase from February of the year before. Getting it down a little bit further down the rabbit hole, ETF options volume, about 198 million contracts. That's a 15% increase over the year before. Index options, of course, index is where we saw some of the craziest and largest moves out there. Index volume up 70% from February 2016 with about 67 million contracts. And towards the end of February, year-to-date volume up 37% to about 20.2. This is ADV now. 20.2 million contracts a day. Again, that'd be nice if that number could hold and if the entire year would be up 37%. I don't think that's the case. That would be a rock'em sock'em year if that indeed was the case. But still, February, a strong month. March looking like it's on track there. I don't know, maybe Matt, you have a lot of this data over there. I'm guessing this doesn't come as a surprise to you. You're crunching the numbers over there every day at ORATS. But it does go to show, kind of reinforce the notion that a little bit of volatility is a good thing for the options world. We got a lot of volatility, so that's arguable and debatable whether net that's a good thing. But net overall, a little bit of vol in the space is a good thing, and it also goes to show how surprising it was. We all kind of commented on this at the end of 2017, how 2017 was a year where vol just continued to erode, and yet we did see options volume up on the year, and that we did see multiple records set in things like fixed options. So it does go to show how aberrant of a year 2017 was as well. Would you agree?
Yeah, the worrisome thing to me, however, is that there is so much trading when things kind of reset, so to speak. I'm wondering and worrying about, people are expecting the market to be there and they're able to get out, for example, of some short volatility exposures when the market starts going down. We're all old seasoned traders. We've seen it go down and keep going down. It's kind of, we haven't really seen that big of a shakeup. And, I did a post about what happened to the market liquidity in February. And even we saw a little bit in this last shakeup here, where the market are really spreading out and the liquidity on the bid and ask are going down. It's putting a lot of pressure on the market makers. There aren't as many market makers out there. There is some evidence that there are other proprietary funds coming in, but as the three of us know, at least, is that you need market makers there in these kind of crazy times. People that have signed up to make markets in volatile situations, and that's what's worrying me, is that when you see these volatile days, there's just not the liquidity. There's not the markets widen out pretty dramatically, I even compared the 4% down day on the 5th of February to a prior flash crash, so to speak, and it was pretty stark how much less liquidity is in the markets right now. So yeah, I mean it's great that we're seeing a lot of volume, but I'm wondering if people are having these short positions and kind of depending on them the market to be there when at some point it might not be there.
Yeah, it is. You're right. I read your piece last month. You can find it, of course, on the ORATS blog, or just go to the Options Insider, search for ORATS on there. You can find it there as well. It'll kind of show you in a little bit of stark reality just how sparse liquidity can get in these extreme events, which is obviously something to be aware of if you're looking to put large positions on and take large things off. And I was actually just talking to one of our former co-hosts on one of our other programs who's now managing some pretty sizable amount of money for some family offices. And he was talking to me kind of off the record, just lamenting how once you get kind of the story we heard at OIC last year, once you get beyond kind of the big 20 or so, your SPYs, your Qs, your Apples, your Facebooks and whatnot, it's kind of hard to get off some size. And so it's interesting and certainly challenging for a lot of people, particularly in this audience, as they're looking to manage money on behalf of their clients and their funds, to try to find those spots where you could put on the strategy and do it in a cost-effective way when you factor in things like slippage and bid-ask spreads and all that stuff, which is why I guess they should be crunching the numbers with you over there, Matt. I'm sure your data will help them figure all that out. John, I'd be curious to get your thoughts on this as well. Obviously, February was net a good month from an overall options volume perspective, even though started off a little bit of a scary there. The roller coaster had kind of that abrupt start to the ride, which was very scary. Then the rest of the ride kind of evened out a little bit. But still, kind of Chris alluded to this a little bit before, too. I'd be curious to get your thoughts on this because, again, this is your first time on the program. We haven't had a chance. I've asked most of our other hosts on the network their thoughts on this. So, net, if you have any thoughts on kind of just the return of vol in February and whether that was a net good thing or bad thing for the space in terms of long-term impact on the options volume. Clearly, in the short term, it was a good thing. But also, I'd be curious your thoughts, too. It's like everyone has a different level to this number. Again, Chris kind of alluded to it earlier, where I kind of refer to it as the take your ball and go home level of VIX. Like, at what point is it a little bit of volatility too much of a good thing? I tend to shake out somewhere around the 35 levels where I see a lot of people starting to say, whoa, something crazy is going on. I'm going to get the heck out of there. Some people will say 30. Some people will even say 25 or 40 or 45. Everyone has their own kind of risk tolerance. I'm curious, first off, your thoughts on those numbers for February, and then B, what is your own personal, you think, take your ball and go home level for VIX, where things are just getting so crazy, and maybe your client's starting to call you up saying, "Hey, I want to be in cash for a little bit."
Yeah, no, that's great. In regards to February, and I'll even back up a little bit further, within capital markets, we saw a significant uptick in our overall volumes starting in fourth quarter of 17. And it was a lot of in anticipation of, the market being, top heavy, or maybe we're looking to rebalance by the end of the year. Maybe we should be putting on some hedges or reevaluating what our portfolios look like. So Northern saw an uptick in volume kind of starting that late 4Q of last year. Now, nobody's crystal ball is that clear to think that the hedges and things like that would hit, the second month of the year in 18. That being said, our volumes were off the charts, just similar to a lot of other folks on the street. I mean, a lot of transactions were happening, both opportunistic and rules-based transactions, just based on the level of volatility that we had. And so that was a welcome sight, especially sitting in the seat that we sit in. So and a lot of our our investors were okay and pleased that as Chris mentioned earlier, the hedging does work. I mean, these are clients that don't really make big moves in the overall portfolio. And so an option solution that could actually prove out to be economically beneficial was a welcoming sight for a lot of these investors. On the personal VIX side, I mean, I have a relatively high pain threshold, so I don't really get too nervous until you're kind of seeing the sustained 30 plus. volatility. I certainly buy into the fact that if it's priced, the VIX complex is pricing in a 30 vol, it is for good reason. It's usually not not unjustified. But this is where we're at today, kind of this high teens, low 20s, and kind of going back and forth. It is a what I like to call just a trader's market, and these are really good instances where you can really look to use options to enhance or protect the view.
It is a good time to be using options, which brings us to our next big story. A lot of us were down at the Risk Management Conference earlier this month in Florida, and they kicked it off with a very interesting study. I know a lot of our audience for this program loves numbers, loves concrete studies and data that they could turn around and talk to their clients about and with. And we have one of those for you here. This came out of the SIBO. They funded a study, pretty much why they revealed it at RMC, just looking at the overall options-based fund space and what's been going on over there. And you might assume over the past year that with volatility kind of in a bit of a downturn, a bit of a lull, that it wouldn't be a banner year and these wouldn't be banner times for options-oriented funds. And yet, pretty much the data is exactly the opposite. This study was put together by our old friends here on the show, Keith Black and Ed Zotto. They've been on the program themselves a few years back talking about a lot of their studies. They do a lot of studies for OIC and OCC. They're kind of the go-to people to study a lot of different options flow and analysis type studies here in the space. And so they put this study together looking at essentially the growth of options-based funds over the past shall we say. This study goes back quite a while. They started this, they kicked it off in 2017, November of last year. They did pretty much trying to put together the entire universe of what they termed SEC-registered options-based funds. They broke down to they found about 105 options-based funds that they actually used from a performance-based analysis. They actually found a lot more, but that also they have other ones in there that they couldn't include for a variety of reasons. They weren't SEC, they were more futures-oriented or things like that. So the actual universe of options-oriented funds is actually a lot larger. But for the performance analysis, they kept it to 105. But they found a lot of interesting things. The total number that they found when they looked at the end of the last year was actually 157. That's up from 135 funds at the end of 2014, last time they actually did this study. So in 3 years, a decent growth rate out there. Again, in spite of the fact that 2017, kind of a wasteland from a volatility perspective, a hard year. I know a lot of people who told me this firsthand, who went out there trying to launch volatility and options-oriented funds in 2017, and they got a lot of pushback from people saying, what do I need options? What do I need a volatility fund for? The market's just going straight up. There is no volatility. So that was a challenging environment to launch an options-oriented fund in, and yet the numbers still grew over that time span. As expected, when there's more funds, there's also more AUM, a record high of about $54 billion. That's up from about $49 billion 3 years ago. Looking at some of the other interesting data, they break down a lot of great stuff in terms of max drawdown and things like that along those lines. In terms of a lot of funds are in there, of course. Our friends over there at Swan are the second biggest in this universe with the Gateway, who's been around, which is crazy to me. They've been around since December of '77, so they probably were quite literally the first fund probably that in the country. I mean, there's still a lot of funds that haven't gotten around to using options in 2018, so they have been using options in 1977. It's kind of mind-blowing. So it's not surprising that they would be the largest. They've been doing it the longest. But Swan up there, number 2. I got a lot of other funds up there as well. A very large universe of funds compiled in this collection. And of course, in this study, and they all do a lot of different things: hedging, managing volatility, doing income. So it's kind of hard. It's kind of like I often refer to as the alts ghetto. Everything gets lumped into the alts category. When you're talking options-oriented, there's a lot of different use cases for options, and they're all kind of lumped together, and they kind of address that in this study as well. Different funds have different performance metrics and different goals that they're trying to do, so trying to analyze them all together collectively. A bit of a challenge. Luckily, these guys have been doing this for a little while. Again, a lot of great visuals. We're going to include this in the show notes, too, including this great chart here. Matt is kind of fascinating looking at this chart here from this, the growth of options-oriented funds from back at the turn of the century, from 2000, when there was a whopping 10 options-oriented funds in this entire country to now 157. That's a pretty impressive growth chart. I know you were down there at the SIBO. I actually missed Ed and Keith's presentation on this chart. So I know you were there when they presented it. So maybe you have some thoughts from their presentation as well. Your thoughts on the study and just kind of the impressive evolution of the options-oriented fund space in the last 10 or 15 years.
Yeah, one of the neat things about being at a conference like this is, I went to their presentation. I got a question in at their presentation, and then we ended up having dinner later on and able to discuss this. So I really enjoyed meeting Keith and Ed, and they do great work. And I actually I brought up the debacle ratio. Mark, you've been proud. And,
there you go.
And they like it.
Is that going to be their next study?
Sit down with me.
We need to get a licensing fee in for that, I think.
I know. I told them that they need to buy you dinner for help on the marketing of this, but they like, because I think that the growth of the options funds out there. I mean, it's kudos to to your show and a lot of the work the OIC is doing on getting the word out. I think people are learning a lot more about options. There's a lot better data out there. Of course, I wish the exchange fees were lower so we could get even more people out. But the market, it's coming our way. It's coming towards options, which is great. And then, as far as the performance, they really sliced and diced it well. I would encourage the listeners to get that link from you, Mark, and look at some of the exhibits. I think they did a really good job on that. Sharpe ratios, Sortino ratios, and even the Stutzer ratio, which is kind of a skewness and kurtosis penalizer. It's kind of an interesting ratio that people could look up, STUTZER. But they look at option-based funds. They look at the BXM, which is the SIBO buy right fund. They look at the put, which is the SIBO put right, and compare all these to all these ratios and such to the S&P, the Treasury bonds, and some foreign ETFs. And again, I thought it was really interesting and to really dive in and what stuck out is some of these put like the put right, it looks the best in the Sharpe and Stutzer, but not in the Sortino. And so I did some research on why that is, and it's just a matter of where you get your income. But I think having a risk related ratio in there would be very helpful. But I think that people are seeing that you can make some good risk adjusted returns on option strategies. And I think that's really what I took out of the presentation, Mark.
Have to have these guys back on the show so we can pitch them officially on our debacle ratio here on the show, because I think that would be a good one. And certainly it makes for the sexy title to a study. You have a debacle ratio study. People gonna want to read that study, I think. A few more nuggets here from this, and again, we'll put the links in our show notes. You can also head on over to cboermc.com and you click on the event from this past March, and you'll see in the agenda all the presentations available there as well. Maybe we'll see if we can link through directly to those as well. I know SIBO a little precious on who can access that stuff sometimes. And it also, this was a SIBO funded study, so you're going to get a lot of stuff in there like put and BXM, which are obviously SIBO products. But if you can see past a lot of that, there's a lot of good data in here to discuss, as Matt kind of hit on. Annualized return, they go all the way back to 1999, so 1999 to 2017. When you look at that there, they kind of broke it down, the options-based universe of funds. Remember that 105 funds they used for the actual performance analysis had a return somewhere analogous to a 60-40 equity portfolio. So you're talking decent, really good risk on the downside, but also pretty good returns on the upside. Somewhere annualized around 4.5% or so over that 1999 to 2017 period. Again, you have an income component to a lot of these funds, so they're going to clip a little bit of the upside there, but still overall interesting stuff. Matt kind of mentioned, the standard deviation on these. The options-based funds are kind of blowing the doors off a lot of other other things out there. The S&P is over 14.5%. The options-based funds as a universe are about 10.5%, so substantially less from an overall standard deviation perspective. Max drawdown also better than the S&P, which is about 51% max drawdown, only 43.9%. Still sizable, but much less for the options-based fund. Of course, you drill down that universe even further, you get into like a hedging-oriented fund or something like that, that max drawdown is going to be even less, which is why, again, it's kind of challenging to lump all options-based funds together, but that's what they had to do for this kind of study. Matt already kind of broke down a lot of the different ratios they use to analyze this, which is also kind of fascinating because you can look at things from a lot of different perspectives. You're looking at all sorts of fun metrics here. I could go on. I know, Chris, this one is of interest to you guys as well, because A, you guys are included in the study, but also B, this is the kind of data you guys like to have, so you can, when you go out and meet with clients, you can talk about this kind of stuff. So A, what are your thoughts and kind of takeaways about this study, and any surprises, B, that you found therein looking at the data?
Well, I mean, it's good to see that the space is growing, and I think it's kind of like along the lines of what Matt said previously here, is education has improving. I remember teaching 15 years ago, and there was barely anything out there of substance. All these studies that the SIBO continues to do, and all these other people are great, because what they have created is this bridge. You know, all of us on this call right now can speak Greek, but a traditional equity portfolio manager, you know, when you start, I know from experience 10, 15 years ago, when you start tossing around those risk measurements that we're all very comfortable with to an equity only or a long short type portfolio manager, it begins to make them uncomfortable. So what has happened over the last years is we've bridged that gap. We've been able to take Greek speak option vernacular and translate that into portfolio manager vernacular, and that has made them very comfortable. And now they're like, okay, I'm interested. How do we use this to, you know, change the return spectrum of the return distribution of our portfolio for our clients? And that's why you're going to continue to see the growth with option-based funds in the future.
John, same question for you. Obviously, you're out there, you know, building that options book over there at Northern Trust, getting the word out about options to a lot of the stable of clients Northern Trust already has, saying, hey, these things are great for hedging and income and all that kind of stuff. So I'm sure this kind of data, these kind of studies are welcome. You were obviously down at RMC as well, so you probably got a chance to test this presentation for yourself. What are your thoughts on this data, and this also in general on the kind of evolving nature of the options-oriented fund space as we get into 2018 here?
I think one of the best things the SIBO did was actually invest and fund a paper like this. For a lot of people, as Chris mentioned, yourself and Matt, is that just getting the information out there in vanilla terms that where people can really wrap their heads around it is what's great. I mean, it's from being an options expert, I love it. I think the industry needs this type of solution, the tool in the toolkit, and using this within portfolios. We put out a little paper article last fall, my boss did, and talking about how Northern sees a trend, specifically focusing on the asset owner space of the market, where we believe that in the institutional space, we've only scratched the surface of the asset owner side of having conversations with clients about option-based solutions. So I'm very excited for what's to come. I mean, being very candid on your show, Mark, this is exactly why I'm at Northern Trust. Being able to be an options expert and talk about option-based solutions, whether that's introducing them to sophisticated managers such as Chris and the Swan team, or being able to react to what a client might be wanting to do in their portfolio and executing that trade on their behalf. It really just the whole gambit is there for us to be having these conversations with clients about, and it's very exciting.
I made a promise at the top of the show we'd get some questions in, so we'll get to those in our office hours in a couple seconds. I want to do a really quick update. A lot of you guys write in all the time with questions about the DOL stuff. It does seem like the fiduciary rule, it's really quickly. Hopefully it's our last update on this for a while, because it does seem like it's kind of dead, at least for the time being. The U.S. Court of Appeals voted 2-1 last week to pretty much vacate this Labor Department's fiduciary rule. You guys know, of course, this has been a very controversial ruling in the financial advisor and RIA space, and of course course, for a while there, it seemed like from an options perspective, it was about to eliminate the use case of options in IRAs. Thankfully, that seems to have been settled. And it also seems like this ruling, at least for the time being, seems to be settled because this got vacated. So now they're saying a lot of people talking in this place that this decision, and pretty much the DOL rule appears to be on life support and will probably be in limbo for the foreseeable future and may eventually go all the way to the Supreme Court, but that'll probably take some time. So in which case, hopefully, this is the last time we get to talk about this for a while here on the show, because that would certainly be a welcome thing for me, even though I know you guys keep writing in with questions about that. Speaking of your questions, let's get to some of them. Let's dive on into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. This is the portion of the show where we take your questions. We field them from all comers, and we have a lot. So I don't know, because you guys ready? Want to stay around for another hour? We can answer some more questions. We probably easily could. Maybe we have to have a special all questions and answer episode one of these days. We'll get to as many as we can. Let's start off. This is an interesting one here from Ed Bankert. We touched on this a little bit on another show we did recently on the network. I thought it'd be great to discuss it here as well. He writes in, I'm debating on using covered calls or short puts. Which is better for a less experienced options trader who wants to make money? Now, obviously, all of us here know synthetically, risk-wise, and a lot of our listeners do as well. Those short put, covered call, same thing. But he brings up a good point. From a novice, from a neophyte, from a new person coming to the options space, they actually are very different from a perception standpoint, and also, I think, from an intuitive logic, an ability to grasp them easily standpoint, they are, I think, very different beasts as well. That's why when I first saw this question, I thought about it, and I tend to lean, I think, towards the covered call, precisely because a lot of people tend to come to the option space usually from the long equity space, so they have that side of the trade already down. They understand that. And if you explain to them that the covered call is a way to pretty much work a limit sell order in the stock and maybe get a little bit of income to do that, they understand that. They can intuitively understand that. Whereas you start telling them, okay, here's a position where you're going to sell something which in turn could be assigned to you, and then you buy it when he drops behind this. So the notion of selling something to buy something is a little bit counterintuitive. I've seen for people who are just coming to options, seems to be like a little bit more of a little bit harder hill to climb for them. That's why I wanted to discuss it on this show, because I'd be curious of your guys' thoughts on this. Maybe you disagree and disagree vehemently. John, maybe we'll start with you as our guest. You get pride of place. When you're talking to new clients, do you find you lean one way or the other, or do you find that it's easier to go down one way or the other, or do you think they're both pretty much the same at the end of the day for you and when you're talking to clients?
At the end of the well, first I'll say, all of us being option experts here, Mark, I'll take the other side of your opinion. And but when you're talking about clients and being able to help them through a solution that they're looking to ultimately do, I'll kind of defer. I'll certainly share my advice, but at the end of the day, I'll execute on what they want to do. That being said, I tend to go the other way. And when you're like, you have a name that you like, and while I certainly agree fundamentally and intuitively, it does not make sense to sell to go long. I like the idea of shorting the put versus doing the covered call because of the inherent capping of your upside when you look to buy stock and sell calls. With the ability to short the put, should you be assigned, you're long the stock, technically at a discount, and you can kind of go on your merry way, not, having 100% of your upside. If you short the put with the not being assigned on your position, you allow yourself more flexibility to either buy the stock at a different price at a different time, or the ability to sell the put once again and get paid for that amount of risk.
That's why I want to discuss it on this show. I figured there might be a diversity of opinions on this. And just to say, I'm with you. Efficacy-wise, I'm much more of a short put guy than I am a covered call guy. I don't tend to own a lot of underlying, so I don't really have a lot of use cases for a covered call. So for my own uses, definitely a short put. But when I'm talking to novices, sometimes I like to lead them to water with the covered call. It seems to be an easier way for them to at least understand the concept. Chris, come on in. What do you think about this? Weigh in on this hotly contested issue here in 2018, covered call versus short put.
Well, for a client, I think the question is, do you want to buy something or do you want to sell something? So I think initially the concept of the covered call is much easier to explain to somebody because we have inherently grown up being long stock, long equity, and people, they grasp the concept of selling their stock at a profit, and that's attractive to them. But, when we start looking and getting into the weeds of option pricing, then you may realize that actually selling that downside put could be a better income kicker than selling a covered call.
There you go. That's 2 votes for covered call, 1 for the short put. Let's see, Matt, you going to make it 3-1 against John, our poor guest getting beat up on here on the first episode? Or are you going to go his way?
Didn't we tell John that you're not supposed to disagree with Mark on the show?
It's the first rule of guesting on my network. I am always right.
I didn't get that memo.
Oh, sorry. Let me type it out here for you. Yeah, I mean, my experience is, with my family, they say, well, we'll sell the stock when it gets up here, and that's where I'm kind of looking at it from. They have the stock. And you could explain, well, if you're going to sell it already, you might as well sell a call, and then if it doesn't get there, you get the income, and So, I have to agree with you because I want to keep on the show, Mark.
3-1. I'm sorry, John. Chris is protesting that he was neutral. Yes, he did. He did add that little political part to the end where he said he also liked puts, but he came in on the side of covered calls first. I put him down in that camp. So I don't know. 3-1, John. We'll see if we can get you. We'll see if we can get made up. See, we got time for really no more, but I'm going to squeeze in one more just because it's fun. I don't think this one's not going to be as contentious. This is a nice, easy, straightforward one. A lot of people commenting on Bitcoin and options. Tom saying, let's be honest, if any of us had size Bitcoin, we would have sold out ages ago and probably be kicking ourselves right now. Yeah, you're probably right. If I had ridden it up, from sub 1,000, I certainly would have held it all the way to 20,000. I probably would have sold it 9 or 10,000. Been very happy with that, of course. You can't get mad at that. Then also in the back of your mind, been like, oh, if I had only waited. So a lot of people I think are in that boat. Again, not a bad boat to be in, but I'm with you there. Let's see. Got one more time for one more actual question here. I like this handle, Johnny Bananas. Johnny Bananas asking, quick question. If you buy a put option and the strike price is $5 and he forgets the word stock, so I'm just going to assume he means the stock, and the stock drops to $3, is it still worth money even if it's under $3? So this guy's a little bit confused, John, about strike prices and puts and what the heck is going on with these things. So let me see if I can break this down for him and for you to answer. So let's see. He buys a put with a $5 strike price, so a stock somewhere around that level. He buys a $5 put, a 5-strike put on the stock, and the stock drops to $3. So break it down for our friend here, Johnny Bananas. Is he happy? Is it worth money even though it's at $3 below his strike? He seems to be confused, John. So set the record straight for him.
Well, I think the short answer and the long answer is it depends. It depends on other factors than just the strike price, and so. Look at, certainly duration, why did the stock drop what it did? Is there a volatility change? So on and so forth. I think the reason to, express a short view, i.e. going long a put on a $5 stock is it's an interesting choice to begin with. I mean, there's other ways that you might be able to look to express that view. But certainly, again, the answer would depend based on multiple factors.
Oh, he's listening to Chris too much. He's getting the political answers going here on the show. And you're right. There's a lot to unpack there. Why would you buy an option on a $5 stock? A lot of people think the stock itself is an option at that point. We'll table that for another day. But net question-wise, buy a $5 put, stock drops to $3. I don't know what you paid for it, but at the very least, it's worth $2, so you're happy from that perspective. Yes, so you were on the right track there, Johnny Bananas, even though there's a lot more to unpack with your question. Unfortunately, that music means we're out of time, so we won't have time to unpack anymore. Keep those questions coming. I know we get a lot of them. for this show. If we don't get a chance to answer them on this show, we route them to some other shows. Maybe we read them all, we try to respond to them all directly, and sometimes the good ones we get to answer on the old programs as well. So keep them coming. Maybe we will do an all Q&A question with this, because we do get so many questions for this show, and we get to gather together here so infrequently. But before we go, let's go back around the horn one more time, check in with everybody, see what they're all working on that may interest you. John, you're our guest, so you get pride of place. If someone's listening to you today and they're interested, they want to learn more about what Northern Trust is doing from an options perspective, maybe they want to reach out and learn a little bit, where should they go? What should they do?
Yeah, I certainly welcome that. As I mentioned a few times within the show, options certainly increasing in popularity, both at the asset owner and the asset manager level. The use cases for what we've seen within the space is rules-based option trading, outsourced to a third-party manager, or doing opportunistic type trading within your portfolios directly with Northern Trust Capital Markets. Certainly would encourage all the listeners and even the folks that I'm joined with today to have conversations and reach out to me directly. John Cherry, Northern Trust Capital Markets.
There you go, John Cherry at Northern Trust Capital Markets. No H, Jon, and then Cherry is pretty much just how you would spell it. So there you go. Reach out, talk to the man, see what's going on at Northern Trust. Maybe it's something that is of interest to you. And Matt, you mentioned you're having people hitting you guys up left, right, and center. So it's obviously a busy time over there at ORATS. Certainly the market conditions kind of favorable to that. So that said, what are you guys working on these days over at ORATS, and what's coming down the pike from you guys?
Well, earlier today I was able to teach a class on personal finance at my daughter's academy. So giving back, and I know that other people on this talk also do the same. So thanks for all what you do, Mark. I think the education is really paying off in the options markets.
Did you get old schools teach them how to balance a checkbook and all that fun stuff too?
And we actually talked about the permanent portfolio and the optionality in there today, where you're actually buying high and selling low. And
optionality! Wow, you really went deep. I like it.
They're very advanced. Anyway, so at ORATS, we released a trade adjustment feature, which is very interesting. You have it. Let's say you have a position on, and the stock moves. You could then move your options away or closer to where the stock is, and that's been very interesting, especially with the market moving around so much. And combining separate strategies. And then, Mark, you'll be happy to know that the extremely long-term, the 133-year option project is in full swing. We're on it, so it's going to be a lot of fun to talk about one of these weeks. So it's busy, it's going well, and it's great to have John and Chris and you on and talk again. So
we can devote a whole episode to your data pretty soon in your study. I'm looking forward to that. In 103 years, that's going to be I think it's going to be some interesting, and I'm going to go out on a limb and say it's probably some surprising developments coming out of all of that data. To my knowledge, I don't know anyone's ever crunched that much data from an options perspective. So that should be pretty interesting stuff. Speaking of interesting stuff, Chris, these have certainly been interesting times for you guys over there at Swan. So what's coming down the pike from you guys? Can we expect any more of your 10th box events anytime soon?
Yeah, well, we're continuing with the 10th box events. You can get more information at 10thbox.com. That's 10thbox.com. But the main event that we've got coming up is our CIO conference in Chicago, May 14th and 15th. That's a good opportunity to discuss the challenges in today's market and how the defined risk strategy can be part of your investment solution.
There you go. Check it out. SwanGlobalInvestments.com is the mecca for all that stuff. They have the Swan blog there. They have the Good, the Bad, and the Ugly newsletter. A lot of great data and research that Mika and the rest of the team, Mark, are all doing over there as well. So head on over there if you need a content fix in between episodes of this show. Speaking of content fixes, our friends over there at OIC, once again, traveling hither and yon, couldn't join us. I did have a chance to catch up with Eric and his team down at FIA a couple of weeks ago, and they're working on a lot of cool stuff over there. You can check it out for yourself at optionseducation.org. Click on the advisor tab. You get access to a lot of great studies like we talked about here today, and you can use them when you sit down with your clients to really arm them with a lot of great data about options and how they could be used in the marketplace. And on behalf of Chris and Matt and John, and indeed myself. I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, of course, sending in such great questions. Keep them coming. And we'll see you next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.